Hello and welcome to the IFRS 15 video, Step 1, Identifying the Contract with the Customer. You might remember from our last video that IFRS 15 introduced a single revenue model to replace the current standards, IS 11, IS 18, and various interpretations. The model consists of 5 steps, and we will look at each step in this and the following videos, starting with the first step. The model starts with the identification of a contract with the customer. For the assessment, we need to respond to 2 questions. Does a contract with a customer exist? And, if it exists, is the contract within the scope of IFRS 15? For the first question, we need to consider the definition of contracts and customers. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. A customer is the party that contracts with an entity to purchase goods or services that are the output of the entity's ordinary activities in exchange for consideration. Let's first look at the characteristics of a contract. It can be written, oral, or implied by an entity's customary business practices. It also needs to meet all of the following 5 criteria. It needs to be approved, which might be in writing, oral, or implied, based on an entity's established practice. Without the approval of both parties, it is not clear whether a contract creates rights and obligations that are enforceable against the parties. The parties also need to be committed to perform their respective obligations, as a contract does not exist if neither party has performed, and either party can unilaterally terminate the wholly unperformed contract without compensating the other party. An entity should be able to identify each party's rights regarding the goods and services promised in the contract. Revenue cannot be recognised related to a contract where the rights of each party cannot be identified, because the entity would not be able to assess when it has transferred control of the goods or services. The payment terms for goods or services should be known before a contract can exist. This is because without that understanding, an entity cannot determine the transaction price. A contract has to have commercial substance if the risk, timing, or amount of the entity's future cash flows will change as a result of the contract. There should also be a valid business reason for the contract, and it is probable that the entity will collect the consideration to which it is entitled for transferring the goods and services to the customer. An entity only applies the revenue guidance to contracts when it is probable that the entity will collect the consideration that is entitled to it in exchange for the goods or services that it transfers to the customer. The objective of the collectability assessment is to determine whether there is a substantive transaction, that is, a valid contract, between the entity and a customer. The entity's assessment of this probability should reflect both the customer's ability and its intent to pay as amounts become due. If an arrangement meets all of the criteria, it is accounted for under the revenue standard. If not, it is not accounted for under the revenue standard, and management will need to reassess the arrangement at each reporting period to determine if the criteria are met. If consideration has been received, it should be recognised as a liability and can only be recognised as revenue when the entity has no remaining obligations to transfer goods or services and the consideration is non-refundable, and the contract has been terminated and consideration is non-refundable. Once a contract has been identified, there is a need to identify whether it is a contract with a customer. Contracts with a customer are in the scope of IFRS 15, except for certain types of transactions. Leases in the scope of IS 17 or IFRS 16, insurance contracts in the scope of IFRS 4 or IFRS 17, Financial instruments and other contractual rights and obligations in the scope of IAS 39 or IFRS 9, or non-monetary exchanges between entities in the same line of business to facilitate sales to current or future customers. Revenue from transactions or events that do not arise from a contract with a customer are not in the scope of the revenue standard and should continue to be recognised in accordance with other standards, such as dividends, non-exchange transactions such as donations or contributions, or changes in fair value of biological assets, investment properties, and inventory from broker traders. Other significant issues to consider when we're identifying a contract are the contract term, when to combine a contract, and contract modifications. For the contract term, this is the period during which the parties to the contract have present and enforceable rights and obligations. It impacts the determination and allocation of the transaction price and recognition of revenue. Entities should consider termination clauses when assessing contract duration. If a contract can be terminated at any time for no compensation, the parties do not have enforceable rights and obligations, regardless of the stated term. In contrast, a contract that can be terminated early but requires payment of a substantive termination penalty is likely to have a contract term equal to the stated term. This is because enforceable rights and obligations exist throughout the stated contract period. How about the combination of a contract? Multiple contracts will need to be combined and accounted for as a single arrangement where the economics of the individual contracts cannot be understood without reference to the arrangement as a whole. An entity should combine two or more contracts entered into at or near the same time with the customer, or related parties as defined in IAS 24 of the customer, and account for the contracts as a single contract if one or more of the following criteria are met. The contracts are negotiated as a package with a single commercial objective. The amount of consideration to be paid in one contract depends on the price or performance of the other contract, or the goods or services promised in the contracts, or some goods or services promised in each of the contracts, are a single performance obligation. And for modifications. A contract modification should change the scope of the contract, the price of the contract, or both, and exists where the parties to the contract approve the modification either in writing, orally, or based on the parties' customary business practices. There is a contract modification when the contracting parties approve the modification that either creates new or changes existing enforceable rights and obligations of the contracting parties. Contract modifications are accounted for either as a separate contract, if the scope of the contract increases because of the addition of distinct goods or services, and the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services, and any appropriate adjustments to that price to reflect the circumstances of the particular contract. Or as part of the existing contract when the modification does not meet the criteria to be accounted for as a separate contract, either prospectively, if the remaining goods or services are distinct from the goods or services transferred before the modification, but the consideration for those goods or services does not reflect their standalone selling prices, or through a cumulative catch-up adjustment if the remaining goods or services in the modification are not distinct and are part of a single performance obligation that is only partially satisfied when the contract is modified. So, identifying the contract is not always as easy as it seems. However, following the areas discussed should help you identify if step 1 of this 5-step approach has been satisfied. We hope this video has been helpful. Look out for step 2 coming shortly.